Welcome to this Killik Explains Finance video. This week, part 2 of my property or shares debate. So, with no more ado, this time 3 property myths. Now, these are things which you hear in relation to property, which I want to suggest are a little bit dangerous. Number 1, it's a relatively straightforward asset to own and manage. Compared to shares, no it isn't. Number 2, the ability to borrow to buy a property is a clear advantage and can work in your favour. True, but it can also work against you, and you can't gear up shares. Number 3, property always goes up in value. No, it doesn't. Over the long term, like shares, it generally rises in value, but with some quite sharp fluctuations along the way. So, let's crack on with those 3 property myths and investigate them in a bit more detail. Now, first of all, property is a complicated asset to buy and own. Here is a selection, just a selection of some of the main costs you'll incur, and each one of these comes with quite a little bit of administration and hassle if you were to buy a property. Now, which property am I talking about here? Don't forget, I am in favour of you owning your own home if you can afford to. Great. I'm also in favour of people buying, holiday homes if they can afford it, properties for their kids. Those are assets as property you're going to enjoy. But as an investment, I'm not so sure. As an investment, for a novice, you've got surveys, local authority searches, solicitors' fees, mortgage arrangement fees, extra insurance costs, stamp duty on a range of 0 to 12%, stamp duty land tax, and that's dead money. You're not going to get that back. You write the cheque, it's based on the value of the property, poof, it's gone. Okay? Renovations, removal costs, and health and safety, making sure that your gas supply, electricity supply, and so on are up to the relevant standard. So a lot of work and it's a lot of cost. Shares, on the other hand, you have got some costs, but they're much more straightforward. Stamp duty, 0.5% of the amount you pay. Commissions, I've guesstimated 1.5% of the amount you pay. It will depend, of course. And bid to offer spreads, if you're setting up a portfolio of large liquid FTSE 100 shares, very, very narrow. That's the gap between the buying price and the selling price of the security. Bit wider on mid caps and small caps, but basically quite tight. What does that mean? It means that were you to invest the average price of a UK property at the time this video was made, £190,000 into shares, it would cost you around 2 to 2.5% of that to get yourself set up. Were you to put an equivalent amount into, say, a buy-to-let property, you'd be easily up to around 4 to 5% in most cases, and depending on the value of the property and therefore the stamp duty you'd be paying, you could be a lot higher than that. And bear in mind that unfairly or fairly, things like solicitors' fees tend to vary depending on the value of the property. So those costs can rise quite significantly if you're fortunate enough to be able to buy an investment property that's quite expensive. So there's one consideration to think about. Here's another one, yields. Now people say to me, great thing about property, great thing about shares is they both generate income. True, but which one is the more reliable source of income? Well, shares, it's fairly straightforward. The past is no guide to the future, but the time this video was shot, the FTSE All-Share offered a gross, that's pre-tax, yield of 3.8%. Now that changes, but 3.8%. The point is, that number at the point this video is made isn't under any debate. If you buy a portfolio of FTSE All-Share shares, that's what you can expect. On top of that, there are a couple of ways you can shield your income with shares. So you've got, from April 2016, the first £5,000 of dividend income tax free. You've got ISAs, which I cover in other videos, as a way of sheltering shares from further income tax. And you've got the possibility of reinvesting income to boost the returns that you generate from shares. Not something you can easily do with property. So not only is the yield reasonably well known and reasonably predictable at the time you set up the portfolio, if you like, but there are ways you can protect it and you can reinvest dividend income. Over here, there are more uncertainties. So the UK average gross yield, according to a couple of sources I looked at on property, 4 to 5%. But the range is massive. All right. If you look at Zoopla and Paragon, 2 of the biggest lenders, depending on where you buy the property and what sort of property it is, everything from sort of student digs through to something more luxurious, the range is 1 to 9%. wherever you are on that range, you've got quite a few issues to think about. Maintenance costs, especially on things like student property, can be high. Void periods where you're not paid rent. Management fees, I mean, all of those can easily knock a quarter or more off your gross yield. You're taxed at your marginal rate. All right, it's not so easy to shelter property in the same way as you can shelter shares. And there's no obvious mechanism for reinvesting your rental income. So, all things to think about before you think, I'll just jump into property rather than jumping into shares. Now, gearing. I hear this a lot. The thing about property is you can borrow, take out a mortgage and gear up your returns. And if the market is kind to you, that will help. Let's take a look at a property costing £200,000, all right? You mortgage £100,000 of it. You borrow £100,000 and put £100,000 in, so you're 50% geared. All right, so that means that the amount you're putting in is 100, the amount the bank's putting in is 100. Now, let's say the price rise is 50%. I've used extreme numbers just to make the point here. It works on smaller numbers too. Your new property value is 300,000. That's 50% more than 200,000. Which means the equity you now own in the property is 200. Why? Because if you sold the property right now for 300, you'd presumably pay off that mortgage debt and the rest is yours. The rest is yours. So you've doubled your money. The equity you put in has, in theory, ignoring costs, tax and so on, doubled. All right? But just bear in mind that if you were to sell the property, you would have some sort of capital gains tax bill. But nonetheless, in gross terms, you've doubled your money. On the other side, let's say you put the £200,000 to work in shares. You can't borrow to buy shares. That's probably a good thing in this country. So debt is zero. You've had to fund those shares yourself, out of your own pocket. All right? The price rise is 50%. This is ungeared. The new value is therefore 300,000, like it was with property. The equity is 300,000 because you didn't borrow to fund this portfolio. So your £200,000 portfolio has risen to 300,000 and that's all yours. That's a return on equity of 50%. In other words, here, basically, you've got a return on equity of 100% thanks to gearing. All right, and I do cover this in more detail in other presentations. Over here, your return on equity is only 50% because you couldn't borrow to enhance returns. All right, and that's the point. In a bull market, gearing is a good thing. But let's turn the tables. Let's turn the tables and say, well, hang on a minute. What if the property and the shares you bought didn't go up? They went down. So, initial cost in both cases, 200. Debt on the left, 100. Same facts. This time the price drops 50%. So the new value of the property is now only £100,000. The equity you've got left at that point is zero, because if you sold the property for £100,000 right there, you'd have to clear this mortgage. You can't just walk away from it, and that leaves you with nothing. And that's before you even pay any other costs. So you've lost all your money if you sell the property. Now, you don't have to sell it, but if you do, you've lost all your money. On the other hand, you couldn't gear the shares portfolio. So £200,000 goes in, there's no debt, the price drops 50%, the new value is 100,000. That's all yours, still yours. So you've lost half your money, but losing half your money is not as bad as losing all of it. And that's the point about gearing. Now, cynics will say, but property always goes up, so you don't have to worry about this. No, it doesn't. All right. Here is the nationwide, all houses, UK, inflation adjusted, so taking inflation into account. Look how bumpy this graph is. All right. That's tracking the market from the mid-1970s all the way up to close to today. And look at all those bumps. So with property, you do have to be prepared for periods of volatility, just like you do with shares. And someone who, and I know people who did this, someone who bought there and then sold there will have taken a horrible loss, magnified by the fact they had to borrow to do it, or someone who bought there and sold there. Again, loss magnified by the fact they had to borrow to do it. So gearing is not a good thing. It just happens to be a good thing if property keeps on rising. As for the debate about where will property go next, will it keep rising? Well, can I just paint a picture about how likely it is that the past can continue? And the answer is not very. If I were to plot from the Halifax data, sort of the period from 1983, based on the average price for house, up to February 2009, that's post-credit crunch, all right, let alone pre-credit crunch. If you think the growth that happened between there and there, roughly the end of the credit crunch, is going to continue indefinitely, well, that would imply that prices will need to hit £825,000 on average by 2035, and that would represent 10 times average earnings. Is that likely? I mean, could you borrow or to buy a property that's 10 times your salary? I doubt it. More likely conclusion is that the past is not going to be a reliable guide to the future of property price rises. Okay, the other factor, of course, remember I listed mortgage costs right back at the start of this presentation, is interest rates. And interest rates are colossally low and have been for a while at just 0.5%, that's the bank rate. At some point, they're likely to go back to something nearer to their historic norm. And that, by the way, depending on which period you look at, is closer to 5%. When that happens, no one knows, but when it does, it'll put extra pressure on people who've bought a lot of property. Conclusion, therefore, same one as part one. Own your own home. It's a good idea for several reasons. If you can afford to own other properties you'll enjoy, great. But beyond that, I, for several reasons I've highlighted here, would rather put my spare cash to work as lifetime savings in the equity market than buy to let. Any questions? To the usual place.